price is never too high or too low. When I was first starting out, I always thought to myself that price has to turn at this level of support and resistance because price is already too high or too low, which is the wrong way of thinking about it. When price starts to trend, it will go on and on and on. So here's an example on the pound Kiwi. As you can see, we had a level of resistance here with 4 rejections. Before price finally breaks through, showing the heavy bullish presence. Now, in your mind, you spot this level here that acted as support, so you draw it in. But as you can see, price breaks right through. And you're probably thinking, I wasn't going to take that trade anyways, because it was a fresh breakout. So next, you look left and you see this next level here, so you draw it in. And as you can see, price had a slight bounce, but then proceeded to break right through again. Now, you spot this level up here that has acted as resistance, and you notice that the last time price got here, it tanked down. And now you tell yourself, price is looking high already. And we just blew through 3 levels, so this level must be a good short trade. Price initially stalls before again breaking right through. So then, you look left and notice this next level of resistance and say, okay, this is finally it. Price is way too high now. It can't just keep going. And we are also approaching overbought RSI. And look at these great candle wicks rejecting this area. But again, boom, it breaks right through. So coming up to this next level is where the actual reversal occurred. Everything that has come before this level showed 0 bearish presence. Price does not truly show the first sign of slowing down until we have these 4 rejections at resistance, a break of the triangle, and a bearish engulfing candle, which is where the true reversal trade occurred. So again, price is never too high or too low. Always wait for price action and confirmation that it is actually ready to reverse. Now, onto the second discovery. When price breaks out, there often isn't a pullback that occurs. A lot of traders like to trade the pullback after a fresh break. But often when price breaks out from a huge turning point, such as a key weekly or monthly level, there often isn't a pullback as price starts to move with heavy momentum. So this is the Aussie dollar pair. This red arrow here is where the trade we will analyze occurred. As you can see, this area is very key and has acted as both support and resistance a vast amount of times. So let's zoom in and I'll show you what I mean. So as you can see, price hits this level of key support and broke out. This is very bullish because we have a break of the trend line, break of minor resistance, and a bullish engulfing candle. Most traders want to wait for the pullback to occur and then enter a trade long. But as you can see, there was no pullback that happened because of the heavy bullish presence, and price took off, leaving many traders in the dust as they missed this amazing trade. So you're probably wondering, why does this pullback not occur? For a pullback to occur, you need 2 things to happen. You either need people who went long to start closing their positions, or you need sellers to start shorting this pair. Now, if you are even a beginner trader, you know that there is a high chance that neither of these 2 things are happening. And if they are happening, it is not happening enough to a scale where it can trigger a pullback. There are only buyers in the market right now, causing it to only have one direction. Think about it from your perspective. Let's say you have seen price in a downtrend for months and months, before finally reversing and you enter a trade long here. Why would you all of a sudden close it so early the second it starts trending upwards? You wouldn't. Now, think about it from a seller's perspective. You notice a fresh breakout showing the heavy bullish presence. Why would you jump in front of the trend and enter a trade short here? You wouldn't. Again, without buyers closing their long positions and sellers entering short, it only has one direction to go. Now, to add more fuel to the fire, more traders will continue entering the market long here, and people who are already in long positions might continue adding more positions as well, which only drives the momentum harder. Now, I'm not saying that pullbacks don't happen, as there is plenty of times when you do have pullbacks occur. You just have to know how to act in both situations, or else you'll miss good trades. So you're probably wondering, how do you get around this problem? To not only take advantage of breakouts without pullbacks, and to not miss amazing trades, but also not to get caught holding the bag when a pullback does occur. We explain this concept more in depth on our website, along with a lot more free content. So check the description below for that. Now, the third discovery is to always check correlations between pairs. What this means is you might spot an amazing trade, but if other correlating pairs are telling you something different, be very careful. Now, I'm not saying that the trade won't go in your favor, but you have to be careful. Here's an example on the dollar CAD. You notice a level of resistance here, so you draw this in. Price then comes up, and then you notice all these beautiful candles rejecting this area. So you're thinking this is a great short trade. If you had entered this trade, your stop loss might have been somewhere around here, and price would have most likely taken out your stop loss before it moved down. Now, if you had checked correlating pairs such as the dollar Swiss here, you would have noticed that price is in a fresh uptrend and is heavily bullish, showing the strength of the dollar. Now, jumping to the euro dollar, you see the same thing. It is in a heavy downtrend, showing how weak the euro is against the dollar, which again shows the dollar's strength. Now, price did end up reversing, but again, you have to always be careful trading against the dominant trend, as swings will occur that don't always work in your favor. So again, always check correlations to understand the bigger picture of the currency in question. Now, the fourth and final discovery is that there will always be something negative in the way of your trade. What this means is you spot a great trade with tons of confluence, but you also spot negative factors in the way. Trust your analysis if it has been tested over time, and if the pros outweigh the cons, take it. So here's an example. Here is the Kiwi dollar. You look left and notice that this is a key weekly level. Price then creates an inverse head and shoulders pattern, which is a bullish reversal, and then breaks out, confirming the reversal. Price then creates a small pullback, which gives you a good trade. Now, some of our beginner traders didn't take this trade because they saw this level in the way, which made them miss this great trade that ended up taking off. From experience, there is always something in the way of a good trade. Focus on the bigger picture and you'll know where the market is truly headed, and you can disregard these minor levels. Now, to recap the 4 key points. 1. Price is never too high or too low. Always wait for the market to tell you what it wants to do. 2. There isn't always a pullback during a fresh breakout. 3. Always check correlations to see the bigger picture. 4. There is always something in the way of a good trade. So just make sure the pros outweigh the cons and take the trade. Now, most importantly, in the comments below, let us know what key things you have discovered about trading Forex over time. And also, let us know in the comments what kind of video topics you want us to cover, and we'll work our best to create them for you. Please like and subscribe to our channel to show your support, as this goes a long way.